Welcome to this breakdown. Today, we are uncovering a hidden financial system, a system that directly impacts the financial stability of nearly every person watching right now. Because, let's be honest, everybody wants their savings protected. That is basic human instinct. You work for decades, you save carefully, and you naturally expect that money to remain secure. But what if the very institution you trust completely to safeguard your savings is quietly exposing you to enormous wealth-destroying risks instead? According to the financial research and tax analysis we are reviewing today, leaving large amounts of cash sitting idle inside a traditional bank account exposes you to three completely separate dangers, and every one of those dangers is happening simultaneously. Now, two of these risks are purely mathematical. They quietly destroy the real purchasing power of your savings every single month without you even noticing. We are going to examine that math very shortly. But the third danger, that is the one your bank will never voluntarily explain to you. It is a regulatory threat. It is the exact risk that causes innocent retirees to get flagged, causes accounts to be frozen, causes names to be added to massive federal databases, and in the worst cases we will discuss today, even results in legally earned money being seized. So in this explainer, we are going to show you exactly how this system works. We will examine the ordinary day-to-day banking behaviors that activate these hidden compliance algorithms, and most importantly, we will break down the same strategies professional financial planners use to preserve wealth and regain financial privacy. Let's begin. To really understand this issue, we need to start with one highly important number, $25,000. This is not a random figure. It is the key threshold everyone needs to understand. If you currently keep more than $25,000 sitting inside one checking or savings account, that account stops functioning as a true safe haven. It transforms into both a mathematical liability and a serious regulatory liability. Now, maybe you are wondering, if this is accurate, why doesn't my local bank manager simply tell me? The answer is extremely simple. Banks make enormous profits when your cash sits idle. The longer your money remains parked inside that account doing nothing, the more profit the bank earns by leveraging it. They have absolutely no financial incentive to warn you about this threshold. And this next point is critical. That $25,000 level is deeply tied to the way the Internal Revenue Service and federal banking algorithms monitor ordinary citizens. The numbers publicly discussed by the IRS are not always the same numbers actually used to monitor activity. Leaving excess cash above this level attracts attention you simply do not need and unnecessarily exposes you to strict compliance systems designed to monitor large, stagnant cash balances. To understand how aggressively this system works in real life, let me tell you a story taken directly from the source material. It involves a man named Robert. Robert is a 68-year-old retired union electrician living outside Columbus, Ohio. He worked for the same company for 34 years. He receives a pension. His home is fully paid off. He was not rich by any means, but he was incredibly disciplined with money. He had maintained a savings account at the same local bank since he was 19 years old. Over time, he built the balance to roughly $140,000. Last winter, Robert decided to help his daughter purchase her first home in Florida. She needed $22,000 for the down payment. Robert had saved his entire life for moments exactly like this. So one Tuesday morning, Robert walked into his local branch, approached the teller, and requested a $22,000 cashier's check payable to a title company in Tampa. The teller looked at the screen and asked Robert to take a seat. A few moments later, the branch manager appeared, escorted Robert into a private office, and began questioning him intensely. Why did he need the money? Who was receiving it? Did anyone instruct him to make the withdrawal? Had he spoken with anyone online recently? Think about that for a moment. a mentally competent 68-year-old man being interrogated by his own bank about helping his daughter using his own money. The manager then placed a full 48-hour compliance hold on Robert's funds. Robert actually had to drive to a gas station payphone and call his daughter to postpone the closing date on her home. And honestly, the most unbelievable part came later. 2 days afterward, once the cashier's check finally cleared, Robert assumed the nightmare had ended. But 3 weeks later, he received another letter in the mail. His completely innocent withdrawal had triggered a permanent federal flag. Robert did absolutely nothing illegal. His only mistake was keeping too much money inside one heavily monitored account. Now, to understand why Robert was flagged, we need to pull back the curtain and examine two completely different banking rules. The first is the rule most people have heard about before, the $10,000 currency transaction report, also called a CTR. Under the Bank Secrecy Act, if you move more than $10,000 in cash during a single day, the bank is legally required to file a CTR with the Financial Crimes Enforcement Network, commonly known as FinCEN. That report contains your full legal name, your social security number, your birth date, and the exact time your transaction occurred. Then it sits inside a massive federal database shared with the IRS, Homeland Security, the DEA, and hundreds of other agencies for 5 full years. But here is the important detail most people misunderstand. Many people believe staying under $10,000 keeps them safe. It does not. The real hidden threat is the Suspicious Activity Report, known as a SAR. A SAR has no minimum dollar limit whatsoever. None. A bank can file one over a $100 transaction, a $500 transaction, or a $2,000 transaction. The decision is made entirely through banking algorithms and internal compliance teams. And here is something most people never realize. You have absolutely no legal right to know whether a SAR was filed against you. In fact, if a bank employee tells you one was filed, that employee commits a federal crime punishable by up to 5 years in prison. No bank worker is risking that for you, because banks face virtually zero punishment for over-reporting customers, but can face millions of dollars in penalties if regulators believe they missed suspicious activity. The entire system incentivizes them to freeze first, report first, and apologize later. Now, this is where algorithmic surveillance starts affecting ordinary people living ordinary lives. There are 7 specific behaviors that automatically trigger modern compliance software and increase the likelihood of a suspicious activity report. Let's go through them carefully. Number 1, pattern changes. If you normally withdraw $500 each week and suddenly request $8,000, the software flags it immediately. A grandmother withdrawing $2,000 for plane tickets to a family reunion can get flagged simply because it differs from her normal activity. Number 2, multiple smaller deposits. We will discuss this one more deeply in a moment, but understand that banks monitor it very aggressively. Number 3, first-time wire transfers. Bank software treats your very first outgoing wire as high risk. The system cannot distinguish between a legitimate payment to a contractor and a scammer stealing your savings. Number 4, round numbers close to $10,000. Amounts like exactly $9,000 often trigger alerts because the software interprets them as possible attempts to avoid reporting requirements. Ironically, trying to stay careful by remaining under $10,000 can actually draw attention. Number 5, deposits that do not match your normal income pattern. For example, if you receive Social Security and suddenly deposit $12,000 from selling a used vehicle without notifying the bank first, the system may flag you. Always create a paper trail beforehand. Number 6, third-party deposits. That includes another person depositing money for you or even using certain overnight drop boxes. And number 7, high-risk geography. Simply interacting with specific zip codes or merchant categories can trigger flags based on association alone. When you combine these 7 triggers together, it becomes obvious why ordinary bank accounts have turned into regulatory minefields. These systems were originally designed to catch major criminals and money launderers, but now let's examine how they create severe risks for completely law-abiding citizens. Remember the second trigger we discussed, multiple small deposits? Federal law classifies that behavior as structuring. Structuring means intentionally splitting transactions to avoid the $10,000 Bank Secrecy Act threshold under Title 31 of the United States Code, Section 5324. It is considered a federal felony. The penalty can include up to 5 years in prison and complete forfeiture of the money involved, even if every dollar was legally earned. Compliance software reviews rolling 90-day windows. So if you deposit $5,000 on Monday and another $5,000 on Tuesday, the system may still flag you. Now you may think, I'm not a criminal. This would never happen to me. But the source material highlights several cases where this exact system devastated innocent people through civil asset forfeiture. Take the case of Carol Hinders. She operated a small Mexican restaurant in Iowa for 38 years. Because her insurance policy limited how much cash she could keep at the restaurant overnight, she routinely made deposits under $10,000. The IRS seized her entire $33,000 operating balance without filing criminal charges. Or consider Lyndon McClellan, a convenience store owner in North Carolina who lost $17,000. Or Andrew Clyde, a business owner in Georgia whose $940,000 was seized, forcing him into a lengthy federal legal battle simply to recover his own money. Under civil asset forfeiture, the government does not always need to prove you committed wrongdoing. Instead, you may have to prove your innocence. And while you fight that expensive and exhausting legal process, your funds remain frozen, all because software identified perfectly logical human behavior as suspicious. Now let's shift to the second major danger associated with keeping excess cash in the bank, pure mathematics. According to the financial data in the source material, the average national interest rate on a standard checking account currently sits around 0.06%. Think about how small that is. An entire year of interest on a large checking balance might barely buy a medium-sized coffee. Traditional savings accounts are not much better at roughly 0.14%. Now compare those tiny returns to inflation running around 3%. What this means is that every month your money sits in a regular bank account, its purchasing power quietly declines. If you keep $50,000 inside a checking account earning almost nothing while inflation runs at 3%, you lose roughly $1,500 in real purchasing power during a single year. You did not spend the money, you did not gamble it away, but you still lost value. The dollars remain visible in the account, but they purchase less food, less fuel, and less housing than before. Meanwhile, the bank takes your exact same $50,000 and lends it out through mortgages and credit cards at rates ranging between 7% and 12%. Look at the scale of that spread. A bank holding $100 million in retiree deposits while paying less than 0.5% and lending at 7% earns roughly $6.6 million annually using money that does not even belong to them. As the source material explains perfectly, you are not truly the customer in this relationship. You are the supplier. The borrower becomes the real customer. Your money sits still. The bank lends it out. They keep the enormous profit spread while you absorb all the inflation losses. And once you understand that relationship, it leads directly into the third major danger of idle cash, FDIC insurance limits. This is a hard mathematical cutoff that leaves excess cash unprotected. Every account at every insured bank is protected by the FDIC up to $250,000 per depositor per bank. So if you keep $300,000 in one bank account and the institution fails, $50,000 is uninsured. You can legally lose it, and no law guarantees you will recover it. Now, many people assume bank collapses only happened during the Great Depression, but recent history tells a different story. In 2023, the three largest bank failures in modern American history, Silicon Valley Bank, Signature Bank, and First Republic, all collapsed within roughly 10 weeks. 10 weeks. Many depositors were protected through political intervention during that crisis, but no federal law guarantees that will happen again next time. The next failure could involve a local community bank. It could happen suddenly on a Friday afternoon, and by Monday morning the doors could be locked without warning. If your excess cash sits above the FDIC limit in one institution, you are taking catastrophic risk while receiving almost no financial benefit in return. So this brings us to the most important question: what is the solution? How do you safely navigate inflation, banking failures, and aggressive compliance systems? Professional financial planners follow one simple golden rule: keep only 3 to 6 months of necessary living expenses in a regular checking or local savings account. For the average retiree, that usually equals somewhere between $15,000 and $25,000, not $1 more. Anything beyond that amount belongs somewhere else. Not because you cannot afford to leave it there, but because every extra dollar beyond that threshold is being monitored by algorithms, eroded by inflation, and used by banks to generate profits you never receive. You absolutely need accessible cash for groceries, gas, utility bills, and ordinary daily expenses. That is what the $15,000 to $25,000 buffer is designed for. But the majority of your savings should be moved into vehicles specifically built for protection, growth, and efficiency. And the source material lays out exactly how to do that. So where should the excess money go? Financial planners commonly rely on 5 safer alternatives. These options provide significantly better yields, government backing, and far less algorithmic monitoring from local branch systems. First, high-yield online savings accounts. Banks like Ally, Marcus, and Discover currently offer rates between 3.5% and 4.5%. Because these institutions operate mostly online without expensive branch networks, they can pay much higher rates. These accounts remain fully FDIC insured, carry no monthly fees, and usually connect directly to your regular checking account for fast transfers. Second, Treasury bills. You purchase these directly from the federal government through Treasury Direct. They currently yield roughly 4% to 4.5%. They are backed by the full faith and credit of the United States Treasury. And importantly, the interest is exempt from state income taxes. Third, Series 1 savings bonds. Federal law guarantees these bonds adjust with inflation. The rate changes every 6 months based on inflation data. Each person can buy up to $10,000 annually, although the bonds must be held for at least 1 year. Fourth, brokered certificates of deposit. Instead of buying weak local bank CDs, investors purchase these through brokerages like Fidelity or Vanguard. This allows access to top rates from hundreds of banks at once, usually between 4.5% and 5%. It also allows large balances to be spread across multiple institutions while keeping every dollar under FDIC insurance limits. And everything can be managed through one simple brokerage dashboard. Finally, money market mutual funds inside brokerage accounts. These funds hold extremely safe short-term government debt, currently pay between 4% and 5%, and provide excellent liquidity. Money can usually move back into checking within 1 business day. Now let's look more closely at one of the most effective strategies on that list, creating a Treasury bill ladder. This is an incredibly powerful method for retirees who want steady access to their cash while avoiding state income taxes and maximizing yield. Here is how it works. Step 1. Purchase a 4-week Treasury bill. Step 2. Purchase an 8-week Treasury bill. Step 3. Purchase a 13-week Treasury bill. And Step 4. Purchase a 26-week Treasury bill. For example, if you have $40,000 available, you place $10,000 into each rung of the ladder. Now here is where the strategy becomes elegant. Because the maturity dates are staggered, one Treasury bill matures every few weeks. You receive your original principal plus state tax-free interest. If you need the cash for repairs, emergencies, or travel, you simply keep it. If you do not need the cash, you reinvest it into a new bill at the far end of the ladder. It becomes a rolling conveyor belt of liquidity. You continuously earn strong government-backed interest. You avoid your local bank's suspicious activity systems, and you always maintain near-term access to cash. For people living in high-tax states like California, New York, Oregon, or Hawaii, this strategy often mathematically outperforms traditional savings accounts after taxes. It can be a complete game changer. Now, as you begin reorganizing your finances, you must stay aware of 3 major deposit traps that frequently impact retirees and instantly trigger compliance reviews. Trap number 1. Required minimum distributions, also known as RMDs. Beginning at age 73, the IRS forces withdrawals from traditional IRAs and 401ks. These distributions often arrive as deposits between $15,000 and $40,000. If that money suddenly appears inside your normal checking account without warning, it may trigger a suspicious activity report. The solution is simple. Send RMDs directly into a high-yield savings account or notify your local branch ahead of time. Trap number 2. Pension lump sum payouts. Some retirees choose a one-time payout of $100,000 or more instead of monthly pension payments. Never direct those funds into a standard checking account. Wire them directly into a brokerage account. Brokerages are built to handle large transfers and generally do not use the same retail compliance systems as ordinary checking accounts. And finally, trap number 3, survivor benefit deposits. This is often the most emotional situation. After the death of a spouse or loved one, life insurance proceeds, or Social Security lump sums may arrive during a period of grief. The last thing a grieving family member needs is questioning from a bank over a sudden $50,000 deposit. Always establish a separate account at another institution before the money arrives. The local branch cannot question a deposit that never entered its system. Now let's return briefly to Robert's story. After enduring the 48-hour hold and permanent federal flag, Robert decided to completely restructure his finances. He followed the exact golden rule we discussed. He kept only $10,000 in his original checking account for regular living expenses. He moved $20,000 into a high-yield online savings account for emergencies. Then he used the remaining funds to build an efficient Treasury bill ladder. Several months later, his daughter needed additional financial help. This time, Robert initiated the transfer through his new structure. Everything happened smoothly in a single afternoon. No branch manager dragged him into a private office. No 48-hour compliance freeze interrupted his life. And no suspicious activity report was sent into a federal database. He had successfully removed himself from the algorithmic crosshairs. Later, Robert summarized the experience perfectly. The biggest surprise was how simple it all turned out to be. Nobody ever warned me how much peace of mind I would gain. By moving money he already owned into accounts he previously never considered, Robert not only increased his monthly interest income, but also regained financial privacy and independence. Once the money left the monitored account, the monitoring largely stopped. And that brings us to the most important question in this entire discussion. Where is your money sleeping tonight? Is it sitting in a regular checking account earning nearly zero while inflation silently destroys its value and banks lend it out for enormous profit? Is it sitting above the $250,000 FDIC limit exposed to possible institutional collapse? Or worse, is it sitting directly inside the crosshairs of aggressive federal compliance algorithms, simply waiting for one unusual but completely legal transaction to trigger a permanent suspicious activity report? The IRS will never call you and explain how to preserve your privacy. Your local bank certainly will not call and explain how to stop them from profiting from your idle savings. The only person who can protect, grow, and secure that money is you. Remember the $25,000 threshold. If excess cash is sitting idle right now, spend time this month researching high-yield savings accounts, Treasury ladders, and brokered CDs. Take control of your financial footprint. Demand a fair return on your savings and reclaim your peace of mind. Thank you for joining me today. Keep learning, keep improving, and continue taking control of your financial future.